Taberne Talks, the first episode of the actual new year. So 2025 has begun, and I ended off the year on a high note last week. Of course, I made the announcement that I went to Movement Mortgage, so that was a great episode that we had. I had a loan officer on from the company that I know directly, Mark Angelone. I thought the show turned out great. Now we're in a new year, right? So it's time to go back to work. I'm pretty happy that we're through the holidays. Felt like a long but a short month, right? So I don't know, but it seemed like we accelerated there the last week, and we're right into it. And I'm happy that I'm here, right? I'm hitting my 28th year coming up in the mortgage business. So we're going to bring you a lot of action as we go through the month, right? So, and every month, I have some really key things lined up, some different things for you guys. So hang in there as we get ready to roll in the market. So I got some good information for you this week. I figured I'd come on alone. Let's start off the year right? And really break down what I think's happening real time. On the street, as I say every week. It feels like that's my favorite line, on the street, right? So I'm going to let you know what's going on. So let's start off with a lot of the declines that I'm seeing right now in the market. Okay, so decline means that you come to a mortgage company, you give them all your information, you divulge your credit, your income, your assets, your employment. You give them everything that they need in order to make a decision on your application for an approval, okay? Let's really watch out for that happening in the new year as we go into some of these companies. I'm seeing a lot of desperation in these companies where they're just approving people off the bat, okay? Approving people off the bat, meaning that they're really not looking at the income documents that you're giving them. They're not looking at the pay stubs. They're not really even running your credit, a lot of them. They're just shooting out a piece of paper saying you're pre-approved, go house shopping, right? And then you get under contract, and then here we go. They can't approve you. I have a specific scenario that I ran into this week where the buyer was approved, or so-called approved, through another company. He went through a very good realtor of mine that I know. The realtor called me on New Year's Eve, said that this buyer wanted to make an offer on the property. He went back to the company that had approved him. The company said, you're no longer approved for a reason that sounded made up. It wasn't something that was common to. They basically said, we don't believe you're going to be living in the home that you're buying, which the guy was a first-time buyer. So I don't know what was going on there. It came down to that we had verified his income, or I verified his income on New Year's Day. His income was way lower than what they projected or what they had approved him with. And he wasn't approved at all with us either. These are the horror stories that are happening in the market every week. Okay. People are coming to us saying, yes, I'm approved. Then I look at them, I put them through processing, and now with Movement's processing is extremely fast. They verify everything. Their technology is unbelievable from what I'm understanding, or what I'm seeing, right? So they're coming in, and they're finding out that these people are truly not approved. Okay. This shatters dreams of people trying to buy a house. This was this guy's first house that he was trying to buy, and here we are. He's no longer able to do it. Watch out there, okay? Another big one that I'm seeing is they're telling people to pay off things in order to qualify. Listen, I would never tell you to pay off your car, your credit cards, your anything, unless I knew truly that you were going to be qualified in order to do it, okay? Number two, I would never tell you to pay off something and then and do it up front, and then again not deliver on what we told you we were going to do, and that's deliver you to closing. I tell people to pay things off at closing. If you need to pay off a car loan in order to qualify, you need to do it at closing. You don't do it up front. Too many lenders are telling them to do it up front, and then these people go and pay these debts off, and then they're still not qualified. So here's a guy who paid off a $25,000 car that he really didn't need to pay off, okay? They told him, yes, pay this off and you're going to be qualified. He goes and pays it off. He's still not qualified. The loan is declined because they're still saying, well, you have other issues with your credit or whatever it may be. Have a lender who's experienced, who looks at the whole picture up front, okay? knows I'm going to make this guy pay off debt, but I'm not going to make him pay it off until the day of closing. Okay. That way, if something happens while they're in process during closing, I didn't make them go pay that debt off. They're just not approved, and they saved their money and didn't pay off the debt. But let me tell you something, you're going to have egg on your face as a loan officer. And as a client, even, you're going to say, well, I lost my savings here because this loan officer told me to go pay this debt off. I went and paid it off, and now I'm still not qualified. Versus the expert who you go to closing with, who makes you pay off the debt at closing, truly said, yes, this needed to be paid off, but don't do it until the day of closing. Watch out, okay? I'm seeing a lot of this. People that are spending hard-earned money, people that have savings that they've had for years, they're finally have the guts to buy a home. They finally get up to the plate and say, let's do this. And then they're told by a so-called expert in the field that they need to pay off debt in order to qualify. They go and pay off the debt, and here we go. They're no longer qualified. Okay. Even though they paid off the debt and they listened to the guy that told them to do it. It's terrible. It really is. It's probably, it's heartbreaking to see these people's faces when they're not qualified and they spent their savings. So we got to really step up to the plate. And if you're an expert in this business, be the expert that you were paid to do. Be the source of information or education that you're paid to do. Okay, to these people, because it'll bite you. And you could ruin your whole company's name. Listen, a loan officer blows a deal up. It doesn't only hurt the loan officer on not getting another deal from that referral source or from that client again. It hurts the whole company name, right? So, Movement, if I blow a deal up, it's going to hurt everybody at Movement, right? Because it's their name also on the line. And I protect that at every cost, not only my reputation, but as a loan officer, you want to try to protect the company reputation. If you're giving them bad information, you're not doing that. Okay. So that's a big one. Another one, property taxes. Okay. So property taxes go up every year, guys. I don't care who tells you what. Okay. Property taxes changed every year. Your house gets assessed every year. Right. And they come to you and they say, yeah, listen, your property taxes are $4,000 this year. Now they're $4,200, or now they're $4,500. It's very rare that you see property taxes go down. Okay. That's great, right? Let's say they come to you and say, well, your taxes are now $3,500 a year and they were $4,000. I don't see that much. I always see them going up. Okay. When you're doing an approval for a client, and you as the client, if you're listening right now, make sure that you tell your loan officer what the property taxes are in the areas that you're looking for. This way, you're not shocked when you feel or when you hear what the mortgage payment is. And you're like, well, why is the mortgage payment so high? Because your property taxes are high. Okay. Property taxes change on every deal. Right? You could bring me a $500,000 house with $10,000 a year in property taxes, or you could bring me a $500,000 house with $5,000 a year in property taxes, and it's going to change your payment dramatically. These are the things you need to relay to your lending company, your loan officer, and say, listen, I'm looking for houses in the $500,000 range, and I'm using an average of $10,000 a year in property taxes, so that when you get your numbers, you're not shocked at what the payment is. You're not told you're no longer qualified, right? These people come to you, and the loan officer will come to you and say, well, you're buying a house at $500,000 and now you don't qualify because the property taxes are so high. That's a problem. So have that conversation with your loan officer. Tell them where you're looking. Tell them what the property taxes are, and let them know this is the range that I'm looking in, and this is where I need to be. Okay. Because it can make or break your deal. All right. So that's a big one. Those are two off the bat. Paying off debt and the property taxes are two that are just a killer. Okay. I touched on this last week with Mark. Mark was a full-time loan officer. He is a full-time loan officer right now. I, of course, am full-time. I'm not putting down part-time people, but right now, in this current market in 2025, it's crucial to work with a full-time professional who's in it for the long haul, right? Who's either been in it, or I don't care, you could have just gotten in the business, but if you just got in the business, you want to work with somebody who's full-time, who is invested in your in your success in buying a home, right? Who knows you need to be available on the weekend, right? You need to be available at nighttime. You don't want to be dealing with part-time people right now, as far as lending companies or companies that only work 9 to 5, companies who are all closed on the weekend. Uh, you need somebody who you can rely on right now. I'm not saying 24/7. I mean, I got a lot of these guys pitching out there. I'm available 24/7. I'm not saying 3 o'clock in the morning, guys, or 2 o'clock in the morning. That gets a little bit crazy, right? So I'm saying be available um, for your clients, right? You got to be full time right now. And as a client coming into this market, because it's a very hard market. I'm speaking to agents every day now. As we got into the new year, I'm speaking to agents where I'm going one on one with. We're either having coffee, we're having lunch, we're doing whatever we want to do. And we are, their biggest gripe to me is it's dead. I'm being honest. It's dead right now. Why is it dead? There's no inventory. The inventory is very low. There's nothing for sale. And the good houses that go on the market, they're gone, right? They move so quick that they don't have a chance to show their buyers that house. So the full-time professionals that are in it you have to value them, right? Because they are the people that are giving you the education that you need, and they are the people that you can rely on if it's on the weekend, if you need to move on something quick. Okay, so just watch out. A lot of the stuff that I say on my show is more of warnings and more of things that I try to relay to you guys, because I'm seeing it every day. And the people that I have on, they're telling you the same thing that I'm telling you right now. Some of them are telling you in other words. Some of them are sugarcoating it. Some of them are really down to earth. It depends on, I guess, the person. But I think it's better not to sugarcoat things in a market that we just lost a lot of loan officers. Okay, we just lost a lot of realtors. Okay, they didn't renew their licenses. I have a stat which I wanted to show. I didn't want to show. I wanted to go over with you over the last 25 years, how many companies have actually, which I can't pull up the stat. I thought I had it on my phone. I'm sorry, guys. I'm a little bit slow here on a Saturday morning. But the stat is the top 15 companies from 2008 are all gone, from Countrywide to Goldman Sachs was doing mortgages then. Chase is downgraded big time versus what they were. There's a lot of companies that New Res, which is back in the game right now. They were back then too, but they went away for a while and then they came back. They're gone. So longevity in this business is tough to come by, especially in 2025. So it's crucial that you pick your company. You do your due diligence, you check what interest rates they're giving you, and you trust the guy that has been in the business for a long time. Okay, so full-time professionals is what I'm pitching right now. Not pitching. I'm that's a wrong word. I'm telling you that you need to work with a full-time professional. Period. Okay, so there's a few things that I want to touch on as far as products. Okay. Products are big right now. One of the main reasons why I went to Movement was because of their products. And one of the main reasons why loan officers are jumping around right now is because you have to be able to offer products in this market. You need to be able to have programs that you can share, okay, to clients that are looking for different things in order to get into a home. It's like you have to adapt right now. You have to change with the times. It was tough for me to make a decision to move to another company because I was so into what I've been doing for the last 10, 20 years that I've never seen what I've seen now. AI, and I said on a show, about 6 months ago that, don't trust AI, and I was wrong. AI is really coming in to the market big time, and they are, taking over. I hate to say they're a big portion of the market right now. So, the technology is big. So the programs are big, right? So if you deal with a loan officer, ask them what programs they have. Ask them what products can you offer me for my specific situation, instead of just telling me that you only have a 30-year fixed product or move on. Okay. One of them I'm seeing are HELOCs, home equity lines of credit, home equity loans. We're getting hit a lot with a lot of people that are looking to do home equity loans or lines of credit. Okay. We're seeing it, man. I mean, they are coming out of nowhere. Do you guys offer home equity loans? Do you guys offer home equity lines of credit? Do you guys offer second mortgages? I need to pay off debt. I'm looking to combine things. Listen, I'm talking to a guy right now, which I'm not allowed to bring up names on the show because we'll get in trouble, right? So I don't give out personal people's names or things, but I'm going to tell you that he's paying a very low interest rate on his first mortgage, but then he's paying a very high interest rate on his second mortgage, and then he's paying credit card debt on top of it that he's being strangled by. His biggest gripe recently is that he doesn't want to refinance to get rid of that really low interest rate because it would hurt him. On the flip side, if he did the consolidation, he'd be saving over $1,000 a month. Okay. He's also looking into a home equity loan or a line of credit so that he doesn't have to touch that first mortgage that he has, but instead take care of the second mortgage that he has and pay off the debt and combine them both into one. These are options that are available to you. Okay. Don't think you're stuck in someone just telling you, well, you got to do a cash out refi. Listen, I'm a fan of a cash out refi because I think that will help you because so many people have equity in their home that they don't realize they have. But a home equity loan or a line of credit, and Anthony on my team is doing a lot of them. They are other great options that you can look at. And some of them you can close in a week. Some of them it takes 30 days to close. Some of them have better rates than other rates. Some of them are based more on your credit and your equity. Some of them are based on your debt to income ratio. Every company has their own little niche, but make sure that you're looking into a home equity loan if you don't want to refinance the first mortgage that you have. Okay, it's a big thing right now, and I think that you got to make sure that there's options laid on the table if you're looking to pay off debt. This guy is going to do the refinance. He's going to do a cash out refinance. He's going to take the higher rate. He's going to consolidate everything into one. And overall, he's still going to save $1,000 a month. It's a no-brainer. You know why? Because down the road, when these rates eventually come down, knock on wood, whenever that is, I keep saying sooner than later, but I'm wrong. But eventually these rates are going to come down. And I think everybody's going to refi. Right. So if you're taking a home equity loan or you're refinancing or cash out refinancing into a loan with a higher interest rate, just think to yourself, it's probably not permanent. You'll probably be refinancing down the road to get a lower rate anyway. So why not get out of debt now while you have the equity in your house to do it? Okay. Another one that we're being hit with, DSCR loans. Okay. DSCR loans are huge. I talk to loan officers on the street every day. A lot of them are living on this product. Like they're cleaning house with investors. What's a DSCR loan, right? DSCR loan is you're buying an investment property, and you don't want to verify your income, right? You may be self-employed. You may be writing off things that you can't show. You may just want to move quickly on something. You may show income, but it doesn't matter. You just want to move quickly on something and you want to do it the most streamlined way that you can do it. Okay. DSCR loan uses what the rental income is going to be, or the projected rental income is going to be, or the cash flow on the property that you're buying. Okay. So, and there's a certain percentage, right, that the bank is looking at, like that you have to cover in order to, they call it debt service coverage, where they want to know that this property cash flows, it's at least 1% or 0.75% over what the mortgage payment's going to be, and is it a good investment for this person? Is it a true investment property? And if it is, good night. They're doing an appraisal, of course they are, but they're doing very limited. There's no reserves. There's no property limits, right? You could buy 10 you could do 10 investment properties, 10, 20 investment properties. There's no limit on how many DSCR loans you can do. So you have investors that are coming into the market now and saying, hey, I'm ready to buy an investment property, 20% down, 25% down. I just want to know what's the most streamlined way I can do it. Okay. And it's a big option. If you want a DSCR loan, just ask, right? If your loan officer doesn't offer you that, then there's a problem. It's an option that's out there that is really being used for your investor community. Hey, listen, you might not even be an investor. Some of these products offer you a DSCR loan and you're a first-time investor. Okay, so the terms might be higher. It might be, rate might be higher, whatever it may be, but they're still offering these different products. So what we like about it is that they close within 30 days, and there's limited amount of things that are being asked for, and they're lenient on the credit. Like we've seen DSCR products down to 660 on the credit score. So don't be afraid. Oh, I got a 670 credit score, 680. They still do them. The rate might not be as good because the credit score is not as high. Again, I'm pitching credit scores being as high as you can get them in 2025 if you're going to buy a home, but it's still an option. Okay. So, listen, I had a client that called me before the show this morning. They can't believe where the interest rates are. We're doing a loan for them right now, and we disclose them on a loan, on a conventional loan, and the rates in the sevens. Okay. It's time to realize that the rates are in the sevens right now. They're kind of upset because they're like, I can't believe the rates are this high. And, we're looking online, and online's telling us that the rates are 6.875. The problem with going online, guys, is that online is never 100% accurate, right? They're not telling you that if there's points involved in the rate. They're not telling you that there's an adjustable rate. They're not telling you that it's an interest-only loan. They're just throwing rates online so that people can call them, and then they suck them into whatever the program that they want to suck them into. And the people are like, oh, great, I got a lower rate. It's time to educate yourself if you're getting into the market. It's time to look online at some really good websites. Mortgage News Daily is the one that I use. It's the one that I give out to my clients all the time. Mortgage News Daily, again, it's not 100%, but it's pretty darn close to giving you what the national average is or the going averages on interest rates right now. If you go on there right now, I think it's like 7.1 or 7.2 as the national average. Now, rates vary, right? You could have a very low credit score. You could be putting very minimal down, and the rates could even be higher than that. But at least that gives you a good clue. If I have excellent credit or very good credit, I'm doing 20% down or 10% down, this is where I should be around. Okay. People are upset. They're mad. They're a lot of not trusting what their companies are telling them. And I'm telling you that the rates have gone up over the last 2 months. Ever since the election, we've seen rates climb at a pretty steady pace. The 10-year Treasury has climbed all the way up to 4.6. If you look at us before the election, we were, in the low fours, high threes. What happened? We're still trying to figure that out. Inflation hasn't gone down. The jobs numbers are still, they're not as bad as what we think they are. There's a lot of reports that are floating that the consumer confidence is still good, which it's hard for me to believe. But on the flip side, the rates are the rates, right? So educate yourself. Look at the different websites, especially Mortgage News Daily. Check out what they're doing and say, hey, listen, now I know, so that when I get into the mortgage process, I have an idea of where the rates should be. I don't have an expectation of a rate being at 6% because that's just not where they are. Okay. So that's a key thing that I wanted to get out there, because I don't want to argue with you on the phone, right? My job is to be friends with you, right? My job is to consult you, but do it in a way that I want to keep you as a client on the next house that you buy, or keep you as a client when you go to refinance, keep you as a client when you want to do a home equity loan, keep you as a client when you want to refer your friends or family to me. My job is not to argue with you. And the problem is I think that a lot of the quality of loan officers, they like to argue with the client, and it's not the way to do it. This client that I spoke to this morning, we went over where the market is. I pulled up some different stats and different things online so that they could see what was going on, so they understood that this is where we are, and that's really the better way to do it. And they thanked me at the end of the call. We're going to touch base on Monday and really start to go over more options to see how I can get their interest rates even lower. Okay, so that's a true professional that you want to work with. So listen, key things to look for in a lender that sends you a pre-approval letter. I wrote 3 things down. Okay. There's 3 things that, if they submit you a pre-approval letter, These three things should have been done before they submitted you that letter. Okay. These tips are for realtors too, because I've had a lot of realtors call me and say, "Hey man, they're approved. What are you talking about? They're done." I mean, I showed them a house today. With what letter? They told me they got good credit, and this other online bank already shot them a letter. So yeah, they said, we're good. That's a problem, right? So number one, you go to a lender and they don't run your credit, but they tell you you're approved. You go to a lender and you say, they ask you, what's your credit score? Well, I went on online today and it's 720. Okay, fine. And they just take your word for it. They don't run your credit. So they took your word for it on what your credit score should be. What? That's insane. Your credit score could be anything. Let's talk about Credit Karma. Credit Karma is not accurate. And I'm probably going to get crushed in the comments on the show this week about me crushing Credit Karma right now. But Credit Karma is not accurate. I don't care what you say. You go on Credit Karma and it tells you that it's a 780 credit score. That's not true. Okay. It may be close to that. It could be 750. But let me tell you something. It could be 620 and you're seeing a 780. Credit Karma is just not accurate. So let's go back to the pre-approval letter. So you're telling the loan officer, I went online this morning at Credit Karma and Credit Karma told me I had a 720. And then your loan officer takes the word for it and says, okay, well then I don't have to run your credit. That's a huge red flag. Credit Karma stinks and your loan officer stinks because they should have ran your credit and not taken your word for it. Okay. Number two, they don't ask about your income. So how do they know you're approved if they don't know what you make? They got to ask about your income. What do you make yearly? What do you make monthly? What do you make hourly? What do you make gross before taxes? If they're not asking these questions, there's a problem. You can't just ballpark somebody's approval without asking what their income is. I don't know what's going on here. It's mind-boggling to me that they're just throwing these letters out on the street to these people and they're not running their credit or asking their income. Number three, they don't ask you about your employment. They don't ask you where you work, what you do, how long you've been at the job. Have you been at the job for at least 2 years? If you haven't, where were you working previously? We got to piece this together. Are you, do you make variable income or are you straight salary? Are you a teacher that's paid over on 10 months or 12 months? They're not even asking the pertinent questions that need to be asked in order to get a solid approval. Look, I'm stuttering on here. Yeah, I don't know why. I know why, because I'm seeing this stuff every week and it's crazy. Ask Anthony. I can't even talk to him on the phone half the time because I'm stuttering to him too, because I'm seeing this stuff. It's like, don't just take somebody's word for it. Verify it. That's our job. This is the job of a loan officer, is to find out as much information as they can up front so that it's easy for you once you go through process and you don't run into hurdles and the homework is done up front. Okay. Not running credit is huge. Income employment is even bigger because we don't know you qualify. And then the letter goes on the street and then these people go under contract. And then I revert back to the story that I told you in the beginning of the show here. You have a problem. They're not qualified. And then everybody goes MIA. Everybody runs for the hills and, no one's around anymore. And okay, great. Then you're left in the dust. You don't know what happened either. I don't get it. You know what it is? I've learned the hard way through my career that doesn't work. Like Mark said last week, we're not perfect loan officers, right? We miss things too, right? Everybody is not perfect. But I've learned the hard way that if you don't do as much homework as you can do up front, or if you don't have a very good processor or assistant to help you do your job good up front, you got a problem. You're not going to make it. You're going to throw somebody into, you could be sued. You could lose your license because you consulted somebody into something that is a disaster now, and they're being sued by the seller of the property. I could go on a half hour about this, and I don't want to because you probably don't want to hear my mouth about it anymore. But I'm going to keep saying it every week because it's happening every week, and it seems like it's accelerating into 2025, and it needs to go the other way. if you are taking this job seriously. I had wrote on Facebook and Instagram and in stories that if you're not being honest to your client, you're not being honest to yourself that you're in this for a career. And that's the truth. That's it. You could lie to people all day, right? You could lie to them and tell them the rate's this, and you could lie to them and tell them that they're approved. You got to look yourself in the mirror at the end of the night and say, I told these people that. And then next thing I know, they're not approved. And what did that get me? Like, you got to be honestly saying that I'm not going to make it as a loan officer then in this career because I'm lying to people. And again, you're lying to yourself then. So I'm going to get off my soapbox there because you're probably, like I said, tired of hearing that, and because I got more to get to. So, okay. So Mortgage Daily News, we went over. It's a good one. This is a big one. So I touched on this a little while ago, about 10 minutes ago or 15 minutes ago on the show, about getting a home equity loan. Okay. We've had a lot of people getting home equity loans in the last month, especially around Christmas, because you guys all rack up debt during Christmas, right? Everybody gets credit cards racked up and all this stuff. So you want to pay off those credit cards. So you're looking to get in a home equity loan. You come to us and then we give you the terms of the home equity loan, right? We say it's 8% or 7% and the payment is $500 a month or $600 a month, whatever the amount is, depending on how much of a home equity loan you need to pay off your debt or do whatever you want to do. Okay. There seems to be a problem here. All right. Here's the problem. There's an actual payment on the home equity loan. You don't go to a bank or a loan officer and say, I want a home equity loan. And then they tell you what the payment is going to be monthly. And you go, really? Oh, $500 a month? $300 a month? They don't think the payment should be anything. Listen, if the bank's going to give you a home equity loan for $40 or $50 or $60,000, you're going to have a payment. It's going to be higher than what you're paying right now, right? You're getting a second mortgage. You're getting another lien on your property, and you're going to have to make a separate payment to that bank in order for the home equity loan. We shocked 2 or 3 people out of nowhere because we told them that they thought they were going to get the money for free and there was going to be no payment. They then talked to us about a cash out refinance. They said, well, okay, what about a cash out refinance? Okay, so your mortgage payment right now is $1,500 a month. We're going to give you $50,000 to pay off all your debt. Your mortgage payment is now going to be $1,900 a month instead of $1,500 a month. What? Why did it go up $400? I'm paying $1,500 a month right now. Shouldn't I be going down because I'm refinancing? No, you're not going down because you're getting an extra $50,000 to pay off your debt. You got to pay for that, right? So it's an extra $400 a month. So your payment's now $1,900 instead of $1,500. Why are we having an argument about this? If we're giving you 50 grand, the payment's going to go up. Now, if you're just refinancing to get a lower interest rate and you're not taking any money out of the house, then your payment's going to go down. Then it's crickets. You know what they say to us? We'll call you back. They never call us back again. We follow up with them and we beat them, we text them, email them. Hi, such and such. We're following up with you. We talked to you last week about refinancing or doing home equity loan. We haven't heard from you since. Are you okay? They're literally MIA. They won't even respond to us. They're gone. They're just gone. Poof. Out. You know why they're gone? They thought that they were going to get cash out of a house or do a home equity loan and the payment wasn't going to go up at all. So this is a word for the wise, this will make you wise, right? You must say to yourself, if I'm going to get a home equity loan or a line of credit, I need to realize that the payment is going to go up. Okay. There's calculators that you can go to online, bankrate.com. Type in bankrate.com mortgage calculator. Okay. Say 40,000 at a rate of 8%. What's my payment going to be? Okay. It's going to kick back. It's going to say $300 a month, whatever it may be. Then you have to say to yourself, that is what it's going to be if I get a home equity loan on top of what I pay monthly for my regular mortgage. So that when you talk to Alex, myself, or anybody on my team, I know I'm talking to myself on a third party here because I'm going crazy, right? But if it's, you talk, then you say, okay, I'm already prepared for Alex to tell me that $300 a month is going to be for the second mortgage. I know my payment's going to go up, but I'm getting ahead. You know why I'm getting ahead? Because I took out that $50,000 to pay off all my debt. So I have no more payments on anything else other than this second mortgage now for $400 a month. It's a no-brainer. You should just say, let's sign the papers, let's close the deal. Instead, they're mad because they're seeing that the payment's going up or they have a second payment. It's mind-boggling to me. I told Anthony this week, it's mind-boggling to me that you would think that you would get $40 or $50,000 or $80,000, and you're not, and the payment's not going up. The payment will always go up. Let's move on. I'm done. That's it. So anyway, um, okay. So VA loans, I always touch on them every week. There's a company out there. I don't think I should say the company name. Can I do abbreviation like it starts with a V and it starts with a V, ends with a U, right? So, or the second word is U. So that's the best I'm going to say. All right, that's it. If you know who you are, okay? VU, period. Guys, look out, okay? VU is not giving the best advice to veterans when buying a house. Okay. Listen, you think that these companies are, because they have that in their name, you think you're dealing with a veteran company directly. You're dealing with a bunch of guys that are sitting in a call center that are being paid hourly and don't know anything about VA loans at all. They're just a call center. Hi, such and such. Yes. It's like your subscription for a magazine. You're calling the guy behind the. He doesn't know anything. He's just selling a magazine, right? He's looking off of his notes and he's saying, "Okay, I want to buy a magazine." They don't know what they're doing. You know why they don't know what they're doing? Because I can send you the declined loans that I've gotten over the last 6 months from this company specifically, who've talked to good veterans who fought for our country, and the next thing you know, they're declined by this company, this specific company. Which again, I'm not going to name the name, but it is terrible. You got to watch out. I understand that, they might give you some type of an incentive to go with them. Well, we're going to give you a lower interest rate. But if they give you a lower interest rate and they pay for your fees and all that, but they can't close, what's it worth? It's not worth anything. They're not doing you a service. They wasted your time for the last 30 or 60 days. They wasted the realtor's time. They made the veterans getting a VA loan a disgrace if they can't approve you the right way up front. Okay. Like I said, I don't like to get into the company name because I think that it's a shame that we're seeing that. And listen, it's not only veterans loans. We could go to, other companies. One of them that looks like a spaceship shooting to the sky, and they do Super Bowl commercials, and they're really big. I'm not going to get into the name of that. We know who they are. And this is another situation. They're approving people on a conventional loan when they shouldn't be approved with a 60% debt to income ratio. You know what that means when you have a 60% debt to income ratio? That means nobody approves you. No conventional loan wants somebody at a 60% debt to income ratio. No VA loan wants you. No FHA loan. That's too high, guys. It's too high. Go online and look up debt to income ratio and see why that's the number one deal killer on top of credit for people that are not versed in buying a house. You'll learn that, debt to income ratio is big. And if you're not getting that service there that you deserve, then you have to look elsewhere. So anyway, top things that I see going into the spring market. We have less loan officers and less realtors in the business. That's, and I didn't wish that, but that's just the truth, right? So I think, we're going to have a busy spring. Mark my words. We're going to have a busy spring because I think the lock-in effect on people is starting to wear out. I saw, kudos to Dave Savage, who I watch online constantly with Mortgage Coach and with, his podcast and his YouTube videos that they do. The lock-in effect, there's more people now more than ever with a rate higher than 5 and 6% than there was over the last 2 years, twofold. Okay. So that in effect is giving you an idea that there are people now that are saying to themselves, okay, I got 3% during the pandemic, I got 2% or whatever it is, but I got to move here and I can't wait forever for these rates to come down. You can't time the market, right? As I've been saying. So they're finally coming out of the lock-in effect, right? And the lock-in effect is starting to wear off. And I think you're going to see more people start to list. I'm talking to realtors, and the realtors have lists of people that are just lined up now that are saying, you know what, once the market turns and And once we get into the spring, I'm going to list. And if I go from 3% to 6% or 3% to 6.5%, I'm happy. I'm going to do it because I want to buy another house. I got to downsize. I want to buy something bigger. I want to move to another state. I want to buy an investment property. They're finally getting it in that this is what it is, and this is what I want to do. Okay, so I think that's one of the big predictions that I see for the spring market is that the lock-in effect will start to really wave down, and I think we'll see volume start to go up, which is good. I think you'll see more first-time buyers come out. The programs are ridiculous right now for first-time buyers. 0 down, 3% down. They give you money towards the grants. They give you, they do buy downs for you, where they buy down your rate for the first year. I mean, there's a lot out there for first-time buyers that is, I think, will trickle in, and then the amount of 30-year-olds. The 30 to 35-year-old club are going to buy. They've been at home long enough now. They're going to buy. They're going to finally say, and that's a huge part of the market that's coming on, is that sweet spot from 30 to 35 that, they were young and now they finally got their jobs in place. They're professionals and they're starting to build families. Some of them may just got married or whatever it may be. They're going to come out too. And so I think, you'll see a lot of that, in the spring. And then I think, again, rates will start to trickle down, by the end of the year. That's a given. Do your taxes, listen, I'm going to add this in. Do your taxes if you're going to buy a home. And if you don't want to, if you're not buying an investment property, so you can't go DSCR unless you buy an investment property, and you don't show any money in your bank statements. That's another self-employed loan that we're seeing, where people use their bank statements for the last 12 months and they use that as income. Like, they do an average over the last 12 months of what you made in your bank statement, and then they use that as your average to qualify because you don't show any money on the books. If you don't show any money in your bank statements, you got to file your taxes and you got to show income. It stinks, right? Because you're going to have to pay. But you're not going to be able to buy a house unless you do that. I can't tell you how many people I've done this past year where we made them go and revise their taxes. We made them go and redo their taxes, and they had to pay $5,000, $10,000, $20,000 in back taxes then to show more income on the books in order to buy a house. That, listen, if you can bite the bullet there and you're fine with that, you're fine with that. But the majority of people that we coached to do that or said you had to do that, they weren't happy. Had they had just shown a little bit more income in the beginning of the year, we wouldn't have had to make them do that. But because they showed no money on the books, I'm talking no money. I'm talking you make $200,000 and you show zero or $10,000 a year. It's a problem. You have to show as much as you can show to buy a house. If you don't have the means to go on a non-QM loan, non-QM meaning like, a bank statement loan or whatever it may be, you don't show the income there in your bank statements or whatever it may be, you got to go the traditional way. And if you can't go the traditional way, then you go no way. You don't buy a house, you get a cosigner. Mom or your daddy has to go on the loan. They got to bail you out. You got to put it in their name. Then you got to refinance down the road to get their name off the loan. It's not pretty. I do it, but it's not a pretty thing. So just keep that in mind when you're going to do your taxes. We're in January now. I think if you get a good game plan on, get a good accountant, and you tell your accountant, I'm going to buy a house and it's going to be this much. I need to show this much. Work it out now. Work out whatever you can work out in order to not be the guy in October who comes to me and says, I want to buy a house, but I only showed X amount of money on the books, and now you can't buy. And now you got to revise your taxes, and now I got to pay a chunk of money in order to do it. Okay? It's another big one. Last but not least, as we go into the new year, there's a factor of, what if I qualify for a home, but I guess the problem is that there's a lot of people companies that are strong arming clients into buying a house the minute that they get pre-approved. Okay. That's not the case, guys. I don't condone approving someone and then just hammering them all day, every day after that. Say, did you buy something? Did you go under contract? Are you making an offer? What's going? Like, I'm going to go back to the desperation thing. I think there's a lot of desperation in the market that the minute that somebody gets approved, boom, they're trying to slam these people into a contract to buy a house on the spot. That's bad news. You know why? Because these people then get cold feet. I read a statistic. Cold feet was one of the number one deal killers over the summer of 2024. Cold feet. They went under contract. They truly never wanted to buy the house, or they felt they were forced, or they were under stress to buy it, and then they get cold feet and then they pull out of the deal. Right. So you order appraisals, you put the loan into underwriting into the process, and then next thing you know, you got cold feet, you don't want to buy anymore. And then you blame the realtor and the loan officer, and you blame everybody around you because you said that they pushed you into going under contract. You never really were truly ready. Okay. That's a problem, right? So pre-approvals, or if someone gives you a qualification letter, it's usually good for 4 months. The reason why I say 4 months is because the credit report is good for 4 months. Your credit score is good for 4 months with that lender. So, listen, over 30 days and 60 days, you have to update your pay stubs sometimes because they want to make sure that you're still making money. It's little things, and maybe they want to see an updated bank statement because they want to make sure you still have enough money to close. They're doing their due diligence. Good for them. But knowing the timeline of how long that pre-approval letter is good for is a plus. 4 months, I tell my clients, and I ask them, what's your range on buying a house? Like, what's your target date of when you think you're looking to close on something? Well, my lease is up in 6 months. If your lease is not up for 6 months and you're not going to do anything for 6 months and on, let's not run your credit right now, because I know that the pre-approval is not going to last for 6 months, right? So I'm wasting your time. Some people say, well, pre-approve them, and then the minute they get the letter, they'll break their lease. I'm not going to bank on that. Right? I'm not going to make somebody break their lease because I pressed them into getting pre-approved. I'm going to ask them their time frame. What's your time frame? How long? When do you think you're going to buy? If it's within 3 or 4 months, then yes, I think we should do the pre-approval, get you ready to go. Okay. And then after that, we evaluate, right? I mean, we update his credit if we have to update his credit if he goes over to 4 months. It's very easy to update somebody's credit. The only thing I got to point out, and I think that we got an email on this week, credit report fees have really skyrocketed. And I've been questioned over the last month on, why is a credit report fee $200, Alex? Why am I getting charged a credit report fee of $250? The last time I did a mortgage, the credit report fee was only $49.99. Times have changed, okay? Credit companies are coming to us and they're hammering lenders and everybody to say credit report fees are now $200 or $250, whatever it may be. It's no longer cheap. And I'm starting to see mortgage companies collect the credit report fee up front from you on a credit card, even to run your credit to do a pre-approval. So be happy that you're dealing with a loan officer that's not asking you for that $200 fee up front. They're collecting it at closing, okay, which is still the majority that are collecting it at closing. But that's the fee, and I'm not lying. Go online, go on Google, type in credit report fees 2025. It'll tell you. We're looking at $200 a pop here, $250 a pop, some of them $300 a pop. Has it gotten insane? Yes. Do I agree with that? No. Am I happy with the days of $40, $50, $60 a month for a credit or per credit report? Yes. I wish it was that. I did that for years. I've seen this serious spike in credit report fees over the last 2 years. They've skyrocketed. The cost of doing business, period, has skyrocketed. The cost of doing a mortgage for lenders behind the scenes has more than doubled and tripled per loan, the cost of doing business. And they're passing it down to everyone. Just like when you go to the grocery store and they're passing down the high prices to you when you buy food. It's the same. Mortgage companies are passing it down to the consumer because who else is going to pay for it? Like I said, just like the grocery market. Who else is going to pay for it? You are. We are, right? I'm not... Listen, if I go buy a house on my own, the mortgage company is going to charge me $200 for the credit report. I'm no better than you. But that is what the fees are right now on credit reports. So getting back to the pre-approval, when we run your credit, again, that credit report is good for 3 or 4 months, let's say. I'm seeing 4. Some companies only do 3. Then they run your credit again. Costs them money to run credit again. It's another $200, $250, and then you shop for another 3 or 4 months. So that's why you got to find out your time frame. A good loan officer is going to ask you your time frame. They're going to work with you through that time frame. They're going to have you approved. They're not going to strong arm you, so you get cold feet. You're gonna do it the right way. Okay, so that's what I got this week. Next week we have a very good realtor coming on. I've known her for years. I'm not going to say her name because the last time I said somebody's name, they didn't come on. They couldn't make it, and then I never heard from them again. Well, I'm not going to name names, right? So I'm just going to say that we have her lined up. She's very good. She's a Jersey realtor. She does PA too. I've dealt with her for years. She's extremely experienced. So I'm looking forward to having her on. And then we're going to move into some other fun things as we get further into the month. I appreciate your comments on the show every week. I'm going to hopefully start answering some of those comments for you as we go through, right? And I want to try to get more interactive with the show as much as I can, because I know that a lot of people are, have questions. So I'm going to welcome questions coming up too. As we work through some of the technology things that we're dealing with. So, because I think that me doing the Q&A show and telling you what I see real time, I'd rather hear from you, and you ask me, what about this and what about that? And how do I get around this and how do I get around that? I think I'd rather hear from you do that. So I think those are some fun things that we got coming up. And if you want to tell me off in the comments, you can tell me off. And I don't know if I'm going to respond to you, but I may. So it depends on the day and how I feel. We'll have to do a night show for that when I have a drink. So anyway, till next week, hang in there, watch the show, keep some of the tips that I told you. Write them down, snip it, whatever you got to do, and take it to heart, because it's the truth. And I will see you guys next week. Happy New Year. Looking forward to you as we go through the rest of the month, and I will talk to you soon. Thank you.